Okay, let's look at some of the key concepts here. Okay, some underlying accounting concepts that we have to look at. So, as an accountant or as any person who has an interest in finance, you are supposed to have the understanding of these concepts. That is when you can actually even manage to appreciate all the most of the topics that you do in accounting, because all of them, they just come from these principles. So you have to understand the principles properly, and then you will be fine. So the first concept that we're going to talk about is called the historical, cost concept. Okay. So this one means that assets are normally shown at cost, and that this is the basis for valuation of the asset. So the basis for the valuation of the assets is that the assets are shown normally at costs. We have the money measurement concept, the second concept. Very, very important concept. Now, with this one, it states that most of the transactions that we record, most of the accounting information that has actually traditionally been concerned only with they have been concerned only with those facts that are covered here. Number one, it can be measured in monetary terms. You record only those where they can actually be measured in monetary terms, and most people will agree to the monetary value of the transaction. If most people agree to the monetary value of the transaction, so only those transactions that you can actually manage to express in the monetary terms, so that you can just record them using the monetary units. And you have to make sure that at least generally people can agree to the monetary value that you give to that particular item. Okay. So now there is always a limitation. Okay. There is a limitation that is referred to as the money measurement concept.
Sir, I can't hear you.
Hello? You can't hear me?
Yes, sir.
I think it should be a mic. Is it everyone can't hear me?
I can hear you.
Okay. All right, now. So the limitation is referred to as the money measurement concept. It means that accounting can never tell you everything about a business. For example, accounting does not show the following. Number one, it does not show whether the business has good or bad managers, because how can you measure, how can you express these variables in monetary terms? It's very difficult. And accounting does not show whether a rival product is about to take away many of the best customers or not. It does not measure whether there are serious problems with the workforce. Okay. It doesn't actually measure whether the government is about to pass a law which will cost the business a lot, okay, of extra expenses in the future. So these things cannot be written down. They are not there, because in accounting, we are just concerned about the things that can be expressed in monetary terms. Is that clear? So the main reasons as to why these transactions are not recorded, these are mentioned that are not recorded, is that it would be very difficult, actually very impossible, to work out the monetary value for them. Okay. Yeah, of course, that value which most of people would agree to. So that is what happens. So there is this monetary measurement concept, shows that at least the things that we write should be expressed in monetary units. Actually, people should also be agreeing to the monetary value that we have assigned. Is that clear?
Yes, it is clear.
Okay. If that is clear, there is also the business entity concept. Now, with the business entity concept, it implies that the affairs of a business are to be treated as being quite separate from the non-business activities of the owners. Very, very important. There is a separation between you, the business owner, and the what? And the business. So the business is a separate entity. That's what this concept means. So the items recorded in the books of the business are therefore restricted to the transactions of the business only, okay? No matter what activities the proprietor, the owner of the business get up to outside the business, they are completely disregarded in the books, okay, kept by the business. Those are not captured. The only time the personal resources of the proprietor affect the accounting records is of the business is when they introduce the new capital or they take away part of capital from the what? From the business. When they do introduce capital or they take drawings out of the business, that's when that's the only time their activities affect the business. Otherwise, their transactions do not affect, like the transactions that are like there is a separation between the business and the individual. Very important to understand this concept because many companies, many people who wanted to do business failed for not understanding this concept. Even if you are the owner, when you get money for the business, you have to give back that money, and of which few of us would do that. You know, when you get money for the business, especially when the business is still small, you don't remember that you got the money for the business. Even if you got a 5 quarter from the business, you have to give the business back the money because the business and you are separate. That's why now when it comes to this, or even people tell you that there is no relationship when it comes to the business. A person shall not come and start saying you are related to the business owner. And this is where people miss it, right? You have relatives or you have relationships with human beings, but the business shall not be affected by those relationships you have, especially negatively. For example, there are some people that just come, they want to bring maybe friendship because you are, to the business. You should understand that the business is not you. You are good friends of those people, but the business is not a friend of those people. Vivian, you're understanding?
Yes, sir, I am.
Now, the other concept that we talk about is the dual concept. With the dual concept, it states that there are two aspects of accounting, okay? The other one represents the assets of the business, and the other one represents the liabilities of the business, okay? So the concept is that these two aspects are always equal to each other. The claims against the business and the assets of the business, they are equal to each other. Maybe to simplify this, we are just trying to say the assets shall equal the total capital plus liability. Okay, you remember you remember the double entry rule where we record the transaction both on the debit side and also on the credit side. Yeah, so all the transactions that we do, usually we observe this double entry system. So that's what the dual aspect concept mean, or the dual concept of accounting means. We mean that the transactions, the business transactions usually have got two aspects, okay? That is to say, there is a part of the gains where you make recordings on the gains part and also on the claims against of the business. Right. The other concept we have is time interval concept. With this one is one of the underlying principles of accounting. So the time interval concept is that it says that the financial statements are prepared at regular interval of usually 1 year. Okay, so for internal management purposes, you may be able to prepare these more frequently. Yeah, possibly maybe on a monthly basis, or even more frequently, maybe weekly if you can manage. But ideally, the point is that there should be time interval. There is an element of time interval so that you can have time to collect data and then publish the records. Okay, so now we also have what is known as the going concern. I will speak loudly about the going concern concept, this one. Now, with the going concern concept, it implies that the business will continue to operate for the foreseeable future, just for the foreseeable future, right? So as a result, if there is no going concern problem, it is considered sensible to keep to the use of the historical cost concept when arriving at the valuation of the assets. Okay, now examples where the going concern assumption should be rejected would include if the business is going to close down in the near future, or where the shortage of cash, let's say maybe where a shortage of cash makes it almost certain that the business will have to cease trading, or maybe where a large part of the business will almost certainly have to be closed down because of the shortage of cash. Now, those are some of the ways or some of the examples. So if you are approached by this, then you disregard this concept may not apply, the going concern concept. So the business shall be there for a foreseeable future, for a given period, actually, of time. Let's make a supposition, however, that a business is drawing up its financial statement, let's say at 31st December 2018. Now, normally using the historical cost concept, the assets would be shown at a total value of 100, let's say 100,000 pounds, okay? That's using the historical cost concept. It is known, however, that the business will be forced to close down in February, that's 2019. That's only 2 months later. And the assets are expected to be sold for only 15,000. So in this case, it would not make sense to keep to the going concern concept, okay? Because we know that this business is closing down very soon. And for that reason, we can reject the historical cost concept for asset valuation purpose, because this business shall not be in operation for the foreseeable future. The concept of consistency just tries to mean that we have to be consistent with the methods that we are using, especially when making calculations. So each business should try to choose the methods which give the most reliable picture of the business. The most common example here would be of when calculating depreciation. You may be aware that there are two methods that you use to calculate depreciation. We use the straight line method, and what? And the reducing balance method, So what usually happens is that if you are just changing, this year you use the straight line method, that other year again use the reducing balance method, it might be very difficult for you to track whether there are changes, okay? Because they have got different impact, okay, of course, on the value of the non-current assets. So the consistency concept simply means you have to be consistent with those methods that you have adopted to use and to calculate whenever coming up or whenever calculating. So the concept actually, the concept says that when a business has once fixed a method for the accounting treatment of an item, it will enter all similar items that follow in exactly the same way. That is the concept. That's what it says. That's about consistency concept, no changing, right? Just be consistent for a given period of time. Now, the prudence concept, this one you should pay much attention to. It is so broad. It is so broad. yeah. What you'll understand is that in oftentimes the accountants will have to use their judgment to decide which figure to take for example, for an item. Okay, suppose you have a debt, you know, maybe let's say a debt has been owing for quite a long time and no one knows whether it will be paid. Now, should the accountants, you know, be an, let's say, the accountant be an optimist in thinking that it will be paid, or maybe be more pessimistic, like, no, it will not be paid. Okay, so usually what happens is that when you are valuing, of course, these assets, as accountants, you are not supposed to overestimate or underestimate the values of the gains and the losses. Okay, so to summarize it, we are saying that as you write or prepare the financial statements, you are supposed to be neutral. That is to say, the gains and the losses should neither be overstated nor understated. Don't overstate the gains and don't understate them. Just be neutral. That's what is there. So most of the times you find that when you're trying to apply the prudence concept, an accountant will normally make sure that all losses are recorded in the books, but that profits and gains will not be anticipated, you know, by recording them before they should be recorded. That's most of the time. Although this is although it emphasizes neutrality, many people, they feel that the prudence concept means that accountants will normally take the figure relating to unrealized profits and gains, which will understate rather than overestimate. So that is what is there commonly. But it is not supposed to be the case. You don't just maybe just record only the losses. Don't just be always pessimistic. Like, try also to record the gains as well. You know, in oftentimes what they do, they just consider the losses. Most of people would want to consider the losses and not to when they're expecting maybe some gain. Let's say they're expecting some gain. What usually happens is that people don't usually count much of that gain. They know that okay, it will come, but they focus much on the losses, thinking negative, that what if it doesn't come? So they raise the negative part higher. So what the concept says is that you have to be balanced. Okay, you have to be balanced. Don't just state only the negatives or the losses, but still you also have to record the gains as well. And this is actually summarized in this or is recorded in what is known as the realization concept, which is just a part of the prudence concept. Okay, the realization concept is part of the prudence concept. With it, it has the view that even the profits and the gains can be taken into consideration, right? You can take both of them into the account. Okay, when a realization has occurred, or that realization occurs only when the ultimate cash reveals the capable of let's say it reviews the assets, the level of assets, or the values of the assets that have been given. So ideally, what happens when you just look at the prudence concept only, if you don't look at it broadly, you may start thinking that as an accountant, you should just maybe just show the negative side, or don't really put into consideration the gains that you're expected of receiving. Don't record them, right? Just record those negatives ones, so that at least when the gains come, we are okay. But when you go to the realization concept, okay, the realization concept will show you that actually also the gains have to be there. Now, the realization concept is part of the prudence concept. It's not really separate from it. Okay, it is not separate from it. All right. The accrues concept. Now, with the accrues concept, this one says that the net profit, okay, the net profit is the difference between the revenue and the expenses incurred in generating those revenues. Okay, so that is what the accrues concept means. So revenue minus expenses shall equal net profit. So now, within the accrues concept, there is this which is called the principle of matching expenses and against revenue, which says that when you are determining the expenses that are used up to obtain the revenues, the expenses that you will have, they will have to be matched up with the revenues, or the revenue to be matched up with the expenses. That is called the matching principle. Now, the matching principle is just part of the accrued concept. Okay. So many concepts, right? They are not finishing. Okay, let me comment on the materiality concept. I will still share with you the good notes of mine. The materiality concept. Now, this accounting concept, it has actually already been discussed. Okay, with the materiality concept, it shows that okay, hello, are you able to hear me? Okay, sorry, like someone had called on the same line I'm using, and they asked this, the mic closed. Okay, so I kept on talking, the mic was off. So now, with the materiality concept, it shows that most of the transactions that you are recording in the financial statements, they should actually be of interest to the stakeholders, okay? Those people who make use of the financial accounting statement, at least those transactions that you record, they should be of interest, they should be useful. Like you don't record the things that are not really useful, that are not that are useless. You get. I would say that you record things that that the people who use the statement may not be interested in. Okay. So you have talked about this. Okay.